Hello, it's Investment Show on Pod TV. My name is Sasha Star, and today we have guests. Dr. Milan Somberg, welcome to the show.
Delighted to be here. Thank you for inviting me. It's a pleasure and an honor.
Thank you so much. As always, it's my pleasure to have you. Jim Eid from Eid Foundation, welcome to the show, Jim. Uh, I hope you're okay.
Sorry, Sasha. I was thanking you for inviting me.
Thank you, Jim, as always. And today, for the first time, and hopefully not the last one, we have a professional investor, money manager, director of many companies, Mr. Michael Blair. Welcome to the show, Michael.
I'm delighted to be here.
Yeah, it's my pleasure. So let's start with, because we have a weekly show, so let's talk about last week on the market, what's interesting, what have you done, and where we are going. If we can start with Milan, please, what's your impression of the markets now?
Well, one thing that I would like our viewers to get out of the show is that Wall Street is not our friend. We need them to execute our orders, but they are not our friend. So I'm going to quote from Michael Blair's book, The Big Short. He said, "The willingness of a Wall Street investment firm to pay me hundreds of thousands of dollars to dispense investment advice to adults still baffles me to this day." I was 24 years old. I had never had an accounting course, never run a business. I did not even have my own savings account to manage. So that's where we are. And I took a friend out for lunch the other day, the multimillionaire guy. And so I said to him how when I was studying dentistry over 50 years ago, we could pay for our tuition through the earnings of a summer job. It can't be done anymore. Oh, says he, Jack's going to make about $80,000 this summer. Jack is his 17-year-old son. He's going to make about $80,000 this summer. I'm a practicing dentist. Dentists make money. I can't make that kind of money. 17-year-old son is going to make $80,000. So the bottom line is this. My friend is a very wealthy investor, and the house which he invests in hired his son and gave him a job. So we see the world as we are and not as it is.
Milan, what job is he doing exactly, earning him
Well,
80?
he is advising adults about how to invest. And what he's doing is he's getting information from seniors in the company. And then he connects to the adults, to the grown-ups, and tells them that we recommend this and we recommend that and so on. And so really you can't trust them. And so that's the job that he had, just like in Michael Bush's book, The Big Short. He never had any experience at all, but he had the right kind of connections.
Mm-hmm. Okay, good.
That's the way the world works, and that's not a part of my world. It's probably not the part of the world of most people who are viewing this program, but that's the way the world works. We see the world as we are and not as it is, but this is how it is.
Okay, Jim, what advice are you following, and have you made already $80,000 this summer? Although it's only started.
If I made $4,000 in a summer when I was in college, I was very proud of myself. Yeah. I didn't expect Milan to go all Buddhist on us, but yes, the perception is what matters. And I agree that, the talking heads on TV telling you what's the latest, hottest stock is, never fall for that kind of stuff. Do your own research, do your own investment strategies. One of the things that I've been thinking about for my portfolio is that I've been worried about companies that are buying back their own stocks, increasing their dividends, all things that are short-term good interest for their stock prices, but they're not paying down their debts. And this is one of the things that I think with the rising interest rates, debt is going to be more expensive. I think it's short-term thinking. It's all about raising the stock prices in the near term, but not necessarily what's good for the companies in the long term. I don't know when and if this is ever going to bite us. I do expect a soft landing, what they call a soft landing from the pandemic and All the recession talk I thought was overblown. I think the Fed's interest rate hikes have been too strict, too severe. I think what's going to help us overcome the economic distribution breakdown that we experienced, which drove prices higher, is to invest in smaller companies that and let them borrow to solve the problem of getting goods and services back to the people that want to make use of them, and don't get in the way of people. The job market's strong. People can still be consumers. Just get the product to them so that they can buy it.
And okay, now the word of wisdom from Michael. I always would like to stress that it is not the stock market, it's a market of stocks. And with that, Michael, what's your opinion, what you're doing these days? And I'm all looking forward to hear from you.
Yeah, just a little background. I started investing in 1971. And in the 1980s, I became a fairly substantial investor when I was managing a portfolio for the company that I had founded, which I used to expand the company. And over the years, I have made hundreds of millions of dollars in my investments, starting with my original investment of $100,000. And my take on the market has always been the same. The wisdom of Warren Buffett is that stock markets are an efficient mechanism for transferring wealth to the patient from the impatient. That investors benefit from lower stock prices, not from higher stock prices. And that if you can buy an interest in the same earnings stream at a lower price, you will have a better result. That when they have a sale at Walmart, people are crushing one another to get in the doors. But when the market is falling, they're jumping off roofs. And there's a whole industry that extracts enormous amounts of money from the market by pretending that one advisor can pick a stock that will rise in price faster than another. But if you look at the market as a whole and the secondary market, the return on investment of investors is less than the return on capital of the issuers. The gap is the difference is the money extracted by advisors and people who are paid based on percentages of assets under management and transaction fees and commissions and the costs of regulation. And so the way, in my view, and it's always worked for me, is learn valuation at a sophisticated a level as you can. Do your own research. My friend Peter Lynch, I met him in the mid 80s, and we used to meet once a month just to talk over investments while he was running Magellan Fund, and he earned an average of about 27% a year for the 14 years he ran Magellan Fund. Since 2012, I've earned an average of just over 18% a year. So I'm not Peter Lynch, but in 2022, my return on my portfolio was 75% in a market that declined 20%. And in 1987, I had a portfolio I was managing of about 150 million. And that year I made 110 million when the market crashed. And I didn't make it by being short. I made it by owning stocks that I had bought well when they were deeply undervalued. And my last comment is this, that I'm primarily an investor in plain Jane industries, largely resource industries. Because I approach the investment in resource industries by treating undeveloped resources as an option on future commodity prices and using a modified Black-Scholes approach to value the undeveloped resources. And what's surprising is the market is not sophisticated in valuing stocks. It prefers to use something an advisor can easily explain to the unwashed, like a multiple of cash flow or a multiple of EBITDA or book value or price to earnings, which are all little snapshots in time of no value when the primary determinant of future cash flows to a resource company is commodity prices over which the management of the resource company has no control. Further, the management, when you discover a resource, you go out of business, you're starting your exit from the business the moment you start to develop it. And so you have all the attributes of an option. The only things you have control over are costs and the timing of when you develop the resource. And so the Black-Scholes, Fisher Black and Myron Scholes and James Merton, they did some really extraordinary work on the differential equations to show there's an equivalence between, at a certain price, an equivalence between the cost of an option, which is the equity value of a resource-based company, and the likelihood that the option will be in the money when the resource is developed, just as a stock might be in the money. And both stock prices and commodity prices are log normally distributed. So this is basically a statistical analysis that lends itself to mathematics. And so I, in March of 2020, when COVID had scared everybody on earth into running from investments, I was buying resource companies at prices that were a tiny fraction of the underlying value of the resource. And typically to date, they're up 10, 15 fold in trading price, but I don't care about that. They're paying dividends, and they're paying dividends that they can afford to pay because they've paid off their debt. And debt is a curse. And so they paid down their debt. And just a couple of examples. I won't keep people here for long, but I bought 140,000 shares of Birchcliff Energy at prices around 88 cents a share. It's now paying 80 cents a share in dividends. And I bought a large block of Peyto Exploration at $1.04 a share. It now pays $1.32 a share in dividends. And those dividends will rise and fall with future cash flows, and they should. Nobody should pay dividends by borrowing money to pay. They should pay dividends from money that's not required to meet their capital requirements in the business. And so I've always sort of laughed at the talking heads that I see on television.
That's us. That's us.
Well, no, we're now talking heads, but talking heads that are saying, this one's really going to go, and every day on BNN and on Bloomberg, I'm listening to people talk about how a tiny movement in the Fed rate is going to be the Fed put, and it's going to cause prices to go up, which I wouldn't like. I'd like them to go down because I've kept money aside. The inevitable recession, I can't wait for it to happen because, I'm not jumping off roofs when the market goes down. I'm wringing my hands and waiting patiently for the opportunity to add to my holdings and keeping cash. I'll make a comment, though, that's about the macroeconomic picture because it's poorly understood. That world energy costs in 2021 were about 6% of global GDP. And in 2022, they were, I may have the years wrong. It might be 20 and 21 or 21 and 22. I think it might be 20 and 21. Yeah, it is 20 and 21. They went up to 16% of global GDP. And the entire worldwide inflation of that period can be related to higher energy costs. And we have regimes around the world that are bought into this quasi-religious specious argument, which is inconsistent with the laws of physics that CO2 emissions cause climate change, which I can assure you they assuredly do not. And as a result, they have piled trillions of dollars into high cost and unreliable so-called renewables while limiting the production of fossil fuels. And the inevitable result of that is over the next 10 or 15 years will be a severe and deepening shortage of production of fossil fuels, which will cause the cycles of the economy to be more volatile. And they will declare success over inflation when commodity prices fall enough that they bring inflation down with them. And then having declared victory, they'll start to stimulate economic expansion into the face of a growing shortage of the fuel that's necessary to power the world. And of course, at the same time, the same governments are borrowing recklessly and beyond the capacity of the societies they govern to carry the debt at some point in time. You see the problems already in Venezuela, in Turkey, in Argentina, emerging in Brazil. The inflation rates across the world are now at very at his high levels for the last 10 or 20 years. They're still at relatively low levels compared to the mid-1970s, but in the United Kingdom and in Europe, there are serious economic problems that the policies that are being put in place are going to exacerbate rather than solve. And so the opportunity for investors, in my view, is relatively simple, and that is stay invested in companies that are profitable and tend to grow with the world economy and have clean balance sheets, and keep cash in reserve, because these situations result in wide dislocations which create opportunities for investors. I'm sorry for taking so long with that little diatribe on the world, but that's my take on it.
Michael, thank you so much for your deep analysis. And from what you just told us, I don't believe that you're a subscriber to the efficient market theory. What do you feel about this concept?
Well, first of all, I'm a big fan of Eugene Fama. And of course, he has many followers. Of course, I've studied not only Fama, but Harry Markowitz and Franco Modigliani and Merton Miller and a whole host of efficient market theorists who have supported it. And it has a certain elegance to it, in that the market is a price discovery mechanism, and as information comes into the market, people buy and sell. But more recent Nobel Prize winners, even like Richard Thaler, have, based on the original work of Amos Tversky and Daniel Kahneman, on how
Psychology.
it's possible for people to make systematically wrong decisions. They overreact to bad news. They underappreciate positive long-term trends. And they're moved by statements by politicians, by macroeconomic conditions, by relatively small events that they think are going to be much larger than they are. And so the volatility in the market gets much larger. And the reality is it's an inefficient market that has periods of reasonable efficiency. and that the idea of the efficient market is quite disputable. It's my friend Bob Schiller has done some excellent work on demonstrating the weakness of the efficient market hypothesis. And Fama himself, who was one of the original authors of the capital asset pricing model, which is really a derivative of the efficient market hypothesis, found it necessary to go from beta being the only measure of relationship between risk and market performance to a three-factor model, including price to book and market capitalization as indicators, to try to come closer to having a valuation model that approximated value. But they're still wrong. I'm just finishing up a master's in securities law, and then I'm an old man, but I'm heading off to university to take a PhD in economics and finance, likely at Western, where they've invited me to come. And I'm going to write about precisely what we're talking about, and that is that the evidence is overwhelming that the efficient market hypothesis, in spite of its popularity and the fact that it sort of came up with the 60-40 pension valuation model and the efficient portfolio and so on, is simply wrong. And as a result, but it's followed by many people. So at the core of highly liquid markets, you have a lot of activity that follows the behavior of money managers. But I should say this, and it's quite important. Money managers are the only people who benefit from higher stock prices, and so they promote them. Because if the underlying economic value of the issuers, the people that are actually producing wealth, the businesses that are producing wealth, has not changed, higher prices just increase transaction fees, increase commissions, and increase percentages of assets under management. And so it shouldn't be a surprise that Larry Fink promotes them. And the current fad towards both climate change disclosure and ESG investing are both charades that punish investors and reward money managers by giving them another spiel to run effectively their bucket shops. Because when you impose profits on costs on corporations that are not compensated by returns on capital, you just lower returns. When you lower returns, pensions suffer, mutual funds suffer, ordinary investors suffer. But
there's another way to look at that, which is when they were pouring toxins into our rivers these types of things definitely help the bottom line of those companies. They were poisoning the flora and fauna around them. So it's not all about returns. I know Milton Friedman thinks that the corporation's only requirement is to make profits, but there is a social cost to the practices that you're preaching.
You're totally right, James, and I agree with that. And I think that the scheme that works is to have the people that we elect enact the laws that protect the environment and punish and set the boundaries within which corporations can operate. But when you start imposing society's goals on corporations, what you're not recognizing is that elections change. Society's goals are not permanent. 50 years ago, people who were homosexual were thrown in jail, and today we have month of parades to recognize their part in society.
The only thing permanent is change.
Yeah, and so if you have the administrative state, the Securities and Exchange Commission, the Ontario Securities Commission, the Canadian Securities Administrators, adopting social goals as goals that are imposed both through corporate and securities laws on corporations, the lag in taking things from acts that have the force of law through the administrative state to the corporations means that the corporations will be operating on goals that are no longer society's goals, well past the point at which society has changed and constantly in conflict, and that you just promote endless parades to the Supreme Court of Canada and the Supreme Court of the United States. That we need corporations to behave ethically and responsibly, and we get that through corporate law and through criminal law, and instead of trying to impose those goals on directors and officers who are ill-equipped to deal with them, we just need more enforcement of the laws that we have. And when poorly managed corporations created the global financial crisis, virtually nobody went to jail. And so making that group of managers responsible for social goals rather than return on capital for the investors on whose money is at stake gives them the opportunity to create long-term incentive plans where the goals are soft and they can extract more money in terms of compensation without having any real responsibility to the returns on investors. And if the net result, and it seems to be the case that it is lower returns on capital, then Canada Pension Plan suffers, OMERS suffers, the Caisse de dépôt suffers, and the people who are dependent on the returns on those investments suffer, but don't receive a benefit. And what I know has been on about 20 different boards. Boards of directors tend to operate with common sense, that the ones that are corrupt and pour toxins into the Great Lakes or something like that. They need to be.
What did you say, Mike, that we have control over? We have control over a limited number of factors. You mentioned we have control over, what was that? I've forgotten. We have control over our asset allocation, and we have total control over our savings rate.
Yes.
What else can we control?
Well, you can control what you select to put your money in.
Yeah.
And I think the best way to chasten corporations that behave irresponsibly is to not lend them money and not invest in them, as well as to have the authorities, in fact, prosecute the wrongdoing that they're responsible for, and not, white collar crime is practically ignored by our judicial system.
Oh, I couldn't agree more. And poor Martha Stewart is the ones that we throw in jail, and it's like, come on. It's ridiculous. It's going on all the time, and the selective prosecution is absurd.
Yeah.
Yes, there's no question. And enforcement, I agree with your comment. In general, the regulations we have are fairly insane because we keep adding to and not deleting as they no longer serve. And so we end up with this crazy bit of regulation. But regulation is an absolute necessity.
Absolutely.
Otherwise, people will engage in things that are harmful. So we must also enforce, and we don't, or we do so selectively. And if you're politically connected or financially wealthy, you're less likely to suffer.
Absolutely right.
Unless you're Donald Trump.
No, but James is absolutely right that the problem is the weakness of the political system in sort of being willing to take on rich and powerful people who are corrupt, and yet that ESG isn't going to accomplish that, and it takes courage and leadership. And the problem we face is that Democratic leaders will buy votes with your taxes because they'll give society what they think will get them elected, and they don't have a long-term horizon when they do that.
The founders of democracy, probably the Greeks, probably Socrates, or roughly at that time, would not approve of the way that democracies are run today. People with an IQ of over 150 who contribute a great deal to society have the same voting rights as somebody who's got an IQ of 70 and moves carts around grocery stores. Socrates would not have approved of that.
Hey, we don't have to go back that far. Our founding fathers, Adams and Jefferson and Monroe and Madison, they wouldn't approve either.
That's absolutely. We have some real benefits. In fact, the Americans more than the Canadians in this respect, and that is, however they arrived at it. The Americans founded a republic, which is a club that has, three co-equal branches of government and real checks and balances. And what we have is a parliamentary autocracy. we put somebody into the office of prime minister who essentially has unbridled power, and it doesn't work as well. That I think it was Villafredo Perito who a couple of hundred years ago did the work to demonstrate that in any group of people, the achievements of the group as a whole are accomplished. 80% of the achievements are accomplished by the square root of the number of people equal to the square root of the size of the population. And then 80% of the achievements of that smaller group are from the square root of the smaller group. And it became known as the 80-20 rule, but it's held up everywhere. And so that the idea that you hamstring the people who have the talent, the ability, the leadership, the creativity, the innovative skills to build Microsoft, Amazon, Google, General Electric, Ford Motor Company, Tesla, and so on, by saying they're somehow evil. Is a mistake.
One of the things that we can learn from the Chinese is that the higher up they go in the regulatory and the government process, the more qualified they need to be. They write civil service exams, which are the difficulty of which is directly related to the office which they're seeking. Here in North America, the American system, Canadian system, anybody can get elected with no qualification whatsoever except popularity.
It's better to have no qualifications. Unless you can
You
criticize.
believe in Jewish space lasers.
Yeah, no, I think that the underlying problem is the absence of a meritocracy, but you know that I think of it in NHL terms. It's there are corrupt people at all levels of all societies, in business and in politics. There are people who will take every advantage of every opportunity, but on balance, we have a pretty good system in Canada, and you know I'm a big critic of Justin Trudeau, but at the same time, I wrote an article recently, but saying that his immigration policy that he fumbled into looks like it's right. That we really have a demographic problem that needs to be solved. We don't have enough people, our ratio of workers to retired people, and I'm one of them, and I think you guys might be as well, is too low for sustainable economic development. We need to shrink the size of the Income Tax Act from 3,300 pages to 10. We need to shrink the size of the Securities Act from over 3,000 pages to 30. We need to bring the corporate laws into line, and we need to start repealing legislation and have legislation that's understandable. As I've been studying law over the years, I'm not a lawyer, I should tell you, but I've taken a graduate certificate in mining law, finance, and sustainability at Western. I'm just completing a master's in securities law at Osgood, and I've been fortunate enough to have the highest grades in both classes. What I learned is that what people who are attracted to the profession are more left wing than the NDP. I was as welcome as a skunk at a picnic in these various classes, because I won't buy into things that don't line up with the laws of physics. So the climate change is out. It's not possible, and I'm not. If it was possible, I'd be front and center dealing with it, but it's not. So I don't.
Michael, I have a very interesting question for you. You were talking about the contradictions of the government regulations. And one, what I cannot explain to myself, what's happening is that recently, as you know, Security Exchange Commissions is suing Coinbase and Binance. And at the same time, they are moving into a new Fed coin, which is essentially a new type of currency, similar to crypto by U.S. federal government. So is there a contradiction that on one hand they are attacking existing the crypto exchanges, and at the same time they're creating their own crypto? How do you take it?
I think it's important to distinguish between a digital currency and a cryptocurrency. Okay, that the emergence of Bitcoin, everybody should get the 16-page memorandum purportedly written by Satoshi Nakamoto that created the paradigm that resulted in cryptocurrencies. The cryptocurrencies, A, they're not currencies. B, they are completely valueless. Secondly, they consume enormous amounts of energy to provide a proof of work, which is of no value, because at either end of you have an exchange to convert actual money into crypto and an exchange at the other end to convert it back. And both of those are less secure than your grocery store. You know, that billions are lost, but it's suddenly enamored a lot of people. But the idea of electronic payments through a digital currency, your Visa card, Interact, your payments from your bank account, those are cryptocurrencies today. All that's happening is the Fed has a unique ability to create the central banks have a unique ability to create a clearing system for transactions that are done digitally that's more robust than any bank has.
So what will happen with the companies like PayPal?
The odd things about fintech are that they tend to have short lives. but they're very effective for as long as they exist. So, I'm fortunate. I have four of my six children are tech savvy. My oldest boy was general manager of Amazon Web Services for a decade before he left to join Google, and now he's a senior tech guy with Capital One Finance. And my youngest guy is an AI expert, and so when I have issues about these things, I talk to people that I know and trust who have knowledge and competence, and they
we need a shout out to your wife, Michael. The two of you did a good job raising those kids.
Well, they got their brains from their mothers, I can tell you that. My first wife was first in her class from grade 1 till she got the Governor General's Gold Medal at Western for the highest grades in the university. And my second wife, who's a lawyer, was smart enough to marry me and dump me.
Was she smart the first time or second time?
Yeah. She came up with millions. It seems to have worked for her, and we have 3 beautiful, brilliant, absolutely brilliant children.
Look at the bright side. Very good, Michael.
Milan I would do it all over again with the same outcomes. I have such spectacular kids, and my youngest 3, the oldest is 27 of that group. He taught himself to read and write when he was 3.
Wow.
Taught himself to play chess when he was 4. He played in Milan's most recent chess tournament, and he won his group, or he tied for the winning in his group, and he was York region champion a few times. And the only guy that I knew that could beat him was his little brother, Jeff.
Well, this tournament actually was a great success, and I congratulate both you and Jim who contributed to this tournament a great deal, and I'm looking forward to the next edition, which will be in May of next year.
Oh, be fabulous.
I'm planning to play. I did very well the first time around, and then I was devastated in the second edition of this tournament, but no regrets, and the next tournament I will try better.
I played, and I won 2 of 5 matches. I lost 3 matches to sub-10-year-olds.
You should know.
I did the same in second tournament.
Jim Eade is an international master.
Oh, fabulous.
Yeah, and he hasn't played because he lives too far away. I don't know what it is. Maybe we can get him here. He's been a financial supporter, as have you, for which I'm grateful. Yeah.
Mm-hmm.
I think it's just one of the great things to get kids interested in it.
I agree.
It just teaches them to think.
Keeps them off the street. Keeps them off the street.
Still and thinking is hard to teach kids to do. It just does it.
And it's a lot healthier than spending their time at the mall smoking pot and playing video games.
This makes your thumbs big. That's about it.
Yeah. No.
And I remember very well around 30 years ago, the early 90s, the company Bankers Trust was specifically hiring chess grandmasters to do derivatives and options and futures and so on. And some of them became very successful at that.
Well, the same kind of mind. I think the people that have that skill or that can play chess well tend to be very strong in mathematics and music.
Exactly.
Yes, agree with you.
That's my kids blow me away. Like I have none of those skills, so I think my math skills are all right, but when I see what they can do, I think, where did I get them from? I tell a joke. My 4 boys are all 6 feet, 175 pounds. So I tell my friends, I don't know who to suspect, but I know what he looks like.
Brilliant. Michael, we are getting very closer to the end of our program, unfortunately, because I would like to spend a few hours with you.
Yes.
But hopefully we will next week. And
that's great. I'm a big fan of Milan, so I just think it's wonderful of him to.
Thank you.
To have sponsored this chess tournament, to invited me to meet you people, because this is fabulous for me. And where are you living, James?
I'm in Menlo Park in just San Francisco Peninsula.
Oh yeah, okay. Yeah.
Mm-hmm.
And so we're all scattered. Where are you, Sasha?
Toronto, Canada.
Okay.
Ontario, I should say.
Yeah, well, I know where Toronto is.
My daughter, though, she lives with her kids and in Collingwood,
I
right
hate,
at the border between Collingwood and Blue Mountains.
I hate to go to Toronto. I don't like to go south of Highway 7 unless I'm ordered to by a judge.
I
But it happened so frequently in the 80s that it stopped being funny.
Oh,
know. My grandkids were in Toronto last weekend, and they are horrified by traffic in Toronto.
oh yes.
They love the city, but the traffic is horrendous.
You know that there are agencies which rank cities for livability. Of the top 10 cities on the planet, 3 are Canadian.
Toronto was one.
Toronto. I happened to be in Toronto the other day for anniversary of some sort, just during the gay parade when it was there. Parking is unbelievable in Toronto, unbelievable. And it's going to get worse. When they build a tower there in Bay and Bloor that reaches up to the sky, every one of those units has a car associated with it. Now, there's some jurisdictions which take the width of the street and allow width and a half height of buildings. That's it. Then you don't have the parking problems which are bad in Toronto and only going to get worse.
Well, when I go to Toronto, I drive to Bradford or Newmarket or Aurora and take the train.
Yeah.
Yeah, that's
I
smart.
don't take my car into
Very
Toronto.
smart.
First of all, it's free parking at the GO station. It's cheaper. The tickets to town and back are cheaper than the parking
would be,
in town.
yeah.
And it's faster.
That's true of a lot of big cities. It's
Yeah.
And so it's
Boston to San Francisco. Same
Michael, my last question to you. If you had absolutely no investments of today, and you would have a sum of money, say $100,000,
Yeah.
and you wanted to invest into the market today, what would you do?
well, I'd get mental health therapy.
$50,000 later.
I'd keep most of it in cash. But if I was compelled to buy by some force to make an individual investment today, I'd make a small investment in a company that's going to hit the market on July 6th called Logan Energy.
Mm-hmm.
And Logan Energy is a spinoff from a company called Spartan Delta. And Spartan Delta, I have a large position in Spartan Delta. I paid about $5 a share, just paid a $9.50 a share dividend. and
Wow.
and it's trading around $5 or $6 still. So I took out the $9.50 and kept the shares. But it's also, together with the dividend, spinning off a small Montney-based oil producer that's producing about 4,500 barrels a day, which is small, but it's coming out at a market cap that's tiny. It's 35 cents a share or something like that. And then, of course, there's the inevitable private placement to management and warrants that went with that, and some warrants coming out with the spinoff and so on. So when the dust settles, there'll be almost 600 million shares outstanding, which puts a market value on the at the time of the distribution on the whole shooting match of somewhere around a couple of $100 million. It has 193 acres of Montney undeveloped land. It has production of 4,500 barrels a day. It has a capital efficiency, meaning the cost to add a barrel per day is about $10,000. It's coming to market with 105 million of cash and no debt, and then it's raising through the warrants and private placement another 150 million. So its capital program for the next couple of years is fully funded. And I don't know what it'll trade at. I have no idea if it's going to come. We'll see. Sometimes those things get sold by people that have no idea what they are, and they just sell them into the market. Sometimes they get bid up by people like me that say it's worth $4 or $5 a share, so at 35 cents, I'm there.
Mm-hmm.
And because I will get for every share of Spartan Delta, 1 share of Logan plus a warrant to buy another share of Logan that's got a life of like 2 weeks at the same price at 35 cents. So I'll exercise all my warrants. And then depending on where they trade, if they're trading south of $1, I'll buy a few 100,000 of them because it's
Well, Michael, how about this? My rule of thumb is if I just hear about it, it's too late.
Yeah.
yeah. Well, I think that's generally true, James.
Sell on news. Buy on rumors, sell on news. Yeah.
Yeah, no. What I find odd sometimes, so I'd put a few $1,000s in that. Instead of I had 100,000 to invest, I'd keep at least 50, and I'd put a few $1,000s in that. The other company I'd put a few $1,000s is an odd company called Nickel 28. Nickel 28 it's got the most corrupt management. We're dealing with that.
Oh God.
But it was a spin-off of a company called Cobalt 27 Capital. And what it owns is a joint venture interest in a nickel cobalt mine in Papua New Guinea, an 8.36% interest. It's a carried interest, so it just gets its share of the cash flow, and the operator of the mine paid its share of the capital and is repaying it out of the cash flow. And it's reached the point now where the debt will be gone within the next 12 to 18 months, and it'll get about 50 million a year of cash flow from its interest in that mine. But it also has a portfolio of streaming contracts with a number of development stage junior mining companies. And the one that's interesting to me is there's a large nickel deposit in Quebec called the Dumont deposit that was owned by Royal Nickel and eventually acquired by private equity for 300 odd million. And Nickel 28 has a 1.75% net smelter royalty on that deposit, which has about 50 years of. First, it's a fully permitted deposit, one of the few fully permitted nickel deposits around.
Well, I would like to spend some time the next show because we run out of time in this show. But the next show, I want to talk to you more about nickel and lithium and cobalt, and because you were talking earlier in the beginning about your resources, and as soon as you start the company, you're ending it as well. But the resource management of these rare earth elements, these types of things, is fascinating to me, and I'd love to talk more with you.
We definitely talk about that. Don't get too hot on lithium. Lithium is one of the most prolific materials on Earth, and its actual content in a lithium-ion battery is small.
Yeah, and I think they're going to move away from it eventually too.
Yeah, well, they're moving away, but they're not because of the cost of lithium. They're moving away because they get different cathodes and different approaches. So you're going to see iron phosphate and so on, and eventually we'll see solid state batteries. They're sort of almost at the point of but what you can't really get away from is copper. And the copper is not just in the batteries; it's also in everything that's electric. And the copper content of an electric vehicle is about 3 times an ICE vehicle.
Little trivia for you: that was King Solomon's mines were copper.
Copper used to be a very good predictor of market movement.
Well, it's still pretty good, but what I think is and
He's
nickel,
coming up, copper.
Nickel and copper are really to some extent cobalt, although there's options there as well. I think to really get into that space, it's more important to understand physics than it is mining. to know where that will go. But the reality is there's not enough copper production, enough nickel production, or enough cobalt production to build anywhere close to the number of electric vehicles that governments are trying to mandate. Nor is there enough capacity on the electrical grids. And
yes.
So the result is going to be
what you're saying is correct, but
they're going to force square pegs into round holes all over the world, and to try and bring about a transition, which is never going to happen because 80% of the world's energy still comes from coal, oil, and natural gas, and $1 trillion of investment in solar and wind just hasn't made a dent in it. It's a tiny percentage of actual output. But the electric vehicle is here to stay. First of all, they're quiet, they're fast, their performance is outstanding, they're simpler to assemble.
Unbelievable, yes.
That they're very, very simple to assemble. They don't have complex chassis. They don't have complex powertrains. And my son owns 3 of them. My oldest boy has got 3 Teslas of different models: a Model X, a Model S Plaid, and a Model 3. And I went for a ride in the Model X, which has the equivalent of 1,100 horsepower.
Yeah.
And I thought, this is nuts.
You just touched the accelerator. It's
Goes like shit. But there's a lot of, because of the enthusiasm that the progressive governments have for EVs, is going to be pushed hard. And you're going to see things like Canada giving away billions of dollars to people to build battery plants that are never going to work. They're going to be white elephants, because those battery plants are Stellantis and Volkswagen, who are never going to produce enough electric vehicles in North America to make those plants economical, which is why they wanted billions of support in
right.
so it's like, it's just, but that's the direction that our politicians are headed, because it's popular with their electorate. But the inevitable result is that everybody should own a small position in copper. It doesn't have to be all that small. You just want to pick debt-free, large resource copper companies with good costs. It's like everything in the resource industry. If you take guys that are indebted,
you're asking for trouble, right?
Cycles will kill them. It's as simple as that. My copper tip for anybody who's interested is
Michael, if you have a small position in copper, a small position in anything, what difference will it make?
well, my small
Milan hits me with this all the time.
my small is a relative term.
Exactly.
So a small position for me, I like to say a small position for me should have, by my estimation, a value of at least $1 million, but not a cost of $1 million. So I what I think is for me to want to hold it, and basically when I establish small position, I value the entity using modern valuation techniques, and I divide $1 million by the number of shares I'd need. And then if I can buy that $1 million worth of shares for $50,000, I'm happy to do it.
Michael, I would like to say.
And then I wait.
I would like to say that we've learned today from you more than listening for 5 years to CNBC or any Bloomberg or anything like that. And I think that both Jim and Milan agree with that. And I'm looking forward so much to see you next week.
Well, we'll do it. I should just say this.
And I recommend all our listeners, because this program is available on YouTube, listen at least 3 times in the next couple of days to this program, and you'll learn a great deal of wisdom from Michael Blair. Thank you very much to you, Jim. Thank you very much to you, and of course Milan. And I would like to say goodbye to everybody, and see you same time, same place next Wednesday. Bye bye.
Bye bye.
Bye bye.